Hey everyone, welcome back to Chipstock Investor. We're going to be focusing on a company that we have had in our portfolio for a long time, the Trade Desk. We haven't done a video on it yet, but we decided we might do one today because it had quite the stock fall off after the most recent earnings. So let's talk about it. We'll go over these three key points. The first one, where does the Trade Desk fit into the digital ad space? The second point that we'll cover is the growth that the Trade Desk has had over the years and where we expect that's going to go. And finally, we will talk about what happened, why the big sell-off after the most recent earnings. But before we jump in, quick word from the sponsor of today's video, public.com. If you're serious about investing, you absolutely need to know about public.com.
That's where you can invest in literally everything: stocks, options, cryptocurrency, even bonds with their new bond account that you can still use to lock in a more than 6% annualized yield.
Public is a FINRA registered SIPC insured platform that takes investments as seriously as you do. Fund your account in 5 minutes or less at public.com/CSI and get up to $10,000 when you transfer your old portfolio. That's public.com/CSI. Here is the Trade Desk's stock chart over the last 5 years. Trade Desk is still up around 200% in the last 5 years. However, you can see that huge drop off after their Q4 2024 earnings call.
Okay, pause that thought right there. We'll come back to that. We'll talk about what just happened. But first, let's just follow our top-down methodology. Where does the Trade Desk fit in the digital ads ecosystem? So we've actually been talking about this at length with our Semiconductor Insider members on our Discord server because we picked AppLovin last year, a little over a year ago now. We finally made our first purchase of AppLovin. And so we've been trying to break down for everybody how these different companies relate to each other.
If you have had a difficult time understanding demand side and sell side platforms for the digital ad space, you're not alone. I think it's a little bit difficult to understand. So hopefully we can break this down into a very digestible fashion.
Hopefully, and we'll pretend like we know what we're talking about as well in the course of explaining this. As you can probably guess, I actually made this chart. That's why it doesn't look as good as the ones that Kasey and Stassi make for us. A DSP is a demand side platform. That is software that works with marketers and their advertising budgets. So these marketers are looking for a place to stick their digital ad. A supply side platform works with the publisher. So that could be something like an online news publication. It could be a blog post. It could be, increasingly in recent years, internet-based TV or connected TV, CTV.
The demand side platform caters to the companies that have something to advertise. I'm going to be doing a deep dive into Shark Ninja. One of our Semiconductor Insider members pointed this out, and I am a huge fan of Ninja products. Think of it like that. A Shark Ninja wants to advertise their latest air fryer. The sell side platforms cater to the businesses that would take that advertisement and show it to the consumer, like maybe an ad during your Netflix show.
Yep. So if you see a Ninja air fryer while you're watching Netflix, if you're subscribed to Netflix ad tier, it's probably because your device is listening to you. I heard Kasey mention Ninja air fryer, and now you can thank Kasey for getting that ad. So when the internet got its start, the secret to the dominance of companies like Google, Alphabet, and Google Search, Meta's Facebook and Instagram, even Microsoft and Amazon, is they actually built out a network that controls both ends of this relationship. Many of these companies have both a DSP and an SSP. This is something the Trade Desk CEO Jeff Green talks about almost every single earnings call, and including this last one. He talked about how Google's DSP or DV360 has this conflict of interest with YouTube, which also is owned by Alphabet, and Alphabet's SSP, the supply side platform. And so a lot of Google's DV360 DSP is funneling advertisements through the YouTube SSP side of the business. It's a huge conflict of interest. It's an ongoing issue, but this is what the internet needed when it was built 20, 30 years ago. It needed a way to pay for this proliferation of content, and ads was the easiest way to get it done. But enter today, where the internet has gotten a lot bigger, trying to get people to use it in the first place by offering free stuff paid for by ads is not the most important thing anymore. And so we've had this growing list of companies, including the Trade Desk, that specialize either as a DSP with the marketing advertising spend on the left, and then a lot of companies that have also focused on the supply side platform that help publishers optimize and get the most that they can for their ad slots that they sell to those marketers. And so just to reinforce this point here, where does the Trade Desk fall into this ecosystem? They are a demand side platform. They primarily work with marketers. Now, they have been expanding into new areas, and we're going to get to that here in a few minutes because this helps answer part of the question about what just happened, what went wrong, what caused the stock to fall so hard after Q4 2024 earnings.
To tee up why there were these missed expectations in this most recent quarter, take a look at the historical growth that the Trade Desk has had over the years. On the left side, gross spend on those digital ads up 25% year over year in 2024, over $12 billion spent, and then the corresponding revenue up 26% year over year. So very solid growth year after year. And the Trade Desk is unique. They haven't made a ton of acquisitions. So most of this has been solely organic growth.
Yeah, it's been an incredible story. These are the adjusted profit metrics that the Trade Desk follows. If you look at GAAP net income, the picture isn't quite as nice looking. And a lot of that is because CEO and co-founder Jeff Green gets a lot of stock-based compensation based on stock price milestones. When the Trade Desk reaches a certain price point, a lot of stock-based comp gets paid out to Jeff Green. So a different issue that we've addressed in other articles before, but on an adjusted basis, you can see the consistent up and to the right profitability, and especially adjusted EBITDA, earnings before interest, tax, depreciation, and amortization, gives you a better picture of the Trade Desk's actual operating profitability, the actual business, what it generates before things like that stock-based comp. You can see the solid results there in Q4 2024, about $350 million in adjusted EBITDA, and then for the full year, just over $1 billion. So for full year 2024, they were moving right along, well north of 30% adjusted EBITDA profit margin. But then in the Q4 2024 report, we got the outlook for the first quarter of 2025. It was a shock. I think the market had sticker shock. The stock price was back at all-time highs. And let's get into point number 3, I guess. This explains what just happened at a high level.
Yes, absolutely. For the first quarter 2025, they say that the revenue will be at least $575 million and an adjusted EBITDA of approximately $145 million. So this implies a 17% year over year revenue growth. However, down 10% year over year on an adjusted EBITDA basis. That's 25% adjusted EBITDA margin. This is definitely not what we were expecting.
No, certainly not. I think there was this expectation that the Trade Desk was going to continue to accelerate, perhaps even reaching 30% revenue growth in 2025 as a lot of enterprise spending continues to normalize after the bear market. So let's dig in a little bit deeper and talk about some of the things that happened recently in the digital ads marketplace that the Trade Desk is saying they basically just missed. Green and the top team were apologetic on the call, and we think we can basically boil what happened down to 2 basic things. There was I think like a 10-point thesis that the management team lined out, but we're just going to boil it down to 2 simple points here.
Yeah, we'll lump those 2 things into the Trade Desk's proprietary software system, and then also a new software platform for connected TVs.
So let's start with this recent announcement that they're making an acquisition, which is a rarity for the Trade Desk. They said at the very end of January that they're going to be acquiring this startup analytics software company. Of course, it's a startup, so AI is very prevalent in the PR from Sincera, but the Trade Desk is going to make this acquisition to bolster their analytics for digital marketers, for those marketing ad dollars. And analytics is an important part of a DSP like the Trade Desk because marketers want to figure out what is their return on investment for their marketing spend. kind of a big deal. If you're dealing with big ad budgets, you want to make sure that the brands that you represent are getting good bang for their buck. But Kasey, this acquisition almost sounds like at this point, now in hindsight, after the Q4 update, that the Trade Desk is making an admission that their core software, DSP software, was lacking in analytics. And Green and Company talked extensively about this on the call about Kokai, which is the latest version of the DSP software platform.
Yeah, this is interesting, Nick, because this announcement that the Trade Desk made was back in June of 2023. So over a year and a half ago now, they launched Kokai, which was the follow-up to their software platform, Solimar. But it sounds like not that many customers or not enough customers actually migrated to this new platform. So adding Sincera, more data analytics, push those customers over the edge to upgrade to that new software, Kokai.
Yeah, and it sounds like the goal for 2025 is to get 100% of the Trade Desk's customers off of Solimar, the previous gen software platform, and onto Kokai. So it seems like Sincera, and again, in hindsight, it just seems like there was something lacking that wasn't getting these customers moving to the newest, latest, and greatest version of the DSP. Now, this is interesting because the Trade Desk has in the past kind of pushed the boundaries a little bit beyond just being a DSP, and adding more robust analytics tools does seem like it could start to step on the toes of some of their software partners. So ad measurement, analytics, data management, and ad security companies like DoubleVerify, LiveRamp, IAS, Integrated Ad Sciences, all of these companies actually are Trade Desk partners, and the Trade Desk making a bigger push into analytics might start to step on some toes. But this is kind of the reality, though, of being a high growth stock with high expectations eventually at some point to keep that growth going. It seems like the Trade Desk is going to have to make more hard decisions like this. And here we go. The acquisition of Sincera might be one of those hard decisions. But if you're a Trade Desk shareholder, it's probably going to be a worthwhile addition to try to get those customers upgraded to Kokai.
Let's now shift focus to the connected TV portion of the problems that we saw with Trade Desk in this most recent quarter. Back in November, the Trade Desk announced Ventura, a streaming TV operating system. Now, why is this important, Nick?
Yeah, an operating system for a smart TV is the software that operates the TV. And usually your TV has some sort of operating system built in. Maybe it's Google Android. So that's where some of Google's DSP and SSP software comes into play and helps them continue to land more ad revenue through things like connected TV. But there's a lot of proprietary stuff out there as well, including this one. We actually knew about this all along, but it kind of got put on the back burner. We forgot about it, but Walmart has actually been in process of acquiring Vizio. Yeah, the TV company, Vizio, for like a year. And they finally completed that acquisition in December of 2024, just a couple weeks after the Trade Desk announced its own operating system. And again, what's interesting about this, the Trade Desk, again, needing to make a push further into the connected TV space and possibly stepping on some toes because Walmart built its e-commerce advertising business using the Trade Desk. So we'll see how this plays out.
This launch of the Ventura operating system will put Trade Desk into competition with some of the SSP partners, like Roku, for instance, and the SSP business that distributes via the Roku TV operating system. Now, the Ventura operating system doesn't exactly make Trade Desk an ad exchange, but it is starting to get a little closer as that operating system acts as a go-between to deliver both the publisher content, like TV shows and movies, and the ads that pay for the content. So it'll be really interesting to see how this plays out over time as the Trade Desk starts stepping on some toes to pursue the full potential of connected TV.
And I promise that's the last time we will say stepping on toes. So the ultimate takeaway here for the Trade Desk and its shareholders is the Trade Desk missed some opportunities, self-admittedly, in things like analytics and this operating system, the connected TV. It seemed like the Trade Desk was all ready to maximize its potential from this migration from old broadcast TV and cable TV to something internet-based. And turns out maybe not so much. I mean, 17% year-over-year revenue growth. The outlook for Q1 2025 is still fantastic, but The dip in the adjusted EBITDA margin definitely indicates they are having to spend some money, having to probably bolster things like employee expense, research and development expense to try to get their growth rate back up above that 20% or higher mark.
So in summation, did that huge fall off in stock price scare us off? No, not at all. We are very happy to remain Trade Desk shareholders, and we actually nibbled a little bit during that fall off.
Yeah, we have no expectation that it's going to rebound quickly. It's probably going to take at least a couple of quarters of reports, good reports, assuming that we have some positive upside here within the next 6 months. So let's say through Q2, maybe even Q3 2025. So it's going to take some time for the Trade Desk stock to return back to those all-time highs. But there is still a lot going on in the digital ads market. It is still very much in growth mode. A lot of advertising is still not being done digitally and certainly not done in a programmatic or automated fashion like the Trade Desk specializes in. And like Kasey said, we're happy to continue holding this one for the long term.
Thanks everyone for watching this episode of Chip Stock Investor. Hit the like button, share with your friends, and consider a membership to Semiconductor Insider. You can find the link to that in the video description below. It's on our Ko-fi page. That's our third-party payment platform, and get you access to Discord, where we have updates on all of the stocks that we talk about in all of our videos. We can't make a video on each one of them, but we can write on Discord. So check it out there, and we'll see you again very soon at Chip Stock Investor.